Thank you for joining today's event. It is my pleasure to turn today's call over to Bailey Davis and Mike Klarfeld. Please go ahead.
Hello, everyone. Thanks for joining us today. This is Bailey Davis, Managing Director, Client Portfolio Manager for ClearBridge Investments. Joining me today is Mike Klarfeld, Senior Portfolio Manager, Managing Director of the ClearBridge Dividend Strategy. Mike, first off, thanks for joining me today. We thought it would be very important to record this call and talk directly with our clients in light of the sharp sell-off we have seen in global markets. Mike, not to put you on the spot, but maybe put it into your own words. How is the Dividend Strategy team thinking about current events as it relates to global markets today?
Yeah, thanks, Bailey, and thanks to all for listening in. I think obviously, like most market participants, we have been following the coronavirus issue out of Asia for the last several months, and have been mindful of it and watching it as it's evolved. At the same time, I think like most market participants, I think we've been surprised, unfortunately, by the unfortunately, the health impacts as it's kind of escalated around the world, and then also the market impacts. I read a really good piece this morning about what's going on in the markets that I thought provides a helpful frame for thinking about what's going on. And this writer talked about how financial crises tend to be either solvency crises, or liquidity crises. And the idea being that a solvency crisis is where the companies or the entities involved may be insolvent. In other words, they have too much debt and they're not sort of fundamentally going concerns or shouldn't be. And contrasting that with liquidity crises, which is where the banking system, the monetary system, financial system is short liquidity. In other words, the underlying assets in companies may actually be reasonably well capitalized and able to withstand what's going on, but investors and market participants need access to capital quickly and don't have enough liquidity. And I think there's components of both going on right now, and it's helpful to think about it like that. So I think when I frame that like that, I think that there are certainly certain areas right now that are having, quote-unquote solvency issues. And I don't mean that quite literally, but sort of more thematically. So you think about travel, restaurants, highly leveraged E&P companies. Those are the kind of entities that, because of what's going on in the world, are truly going to be very negatively fundamentally impacted. Doesn't mean they may not make it, but they're very acutely feeling what's going on. Then there's other aspects of what we see going on in the market that are more like liquidity dynamics. And so you see that at certain points so far, things like utilities have actually sold off very hard. And yet we would think that the fundamental impact of this on utilities is pretty insignificant. Or gold, which did very well earlier, then sold off, which is sort of surprising if you think about what's going on from a monetary policy perspective. You would expect gold to do well. And the point I'd make about those is what you're seeing is a liquidity crisis there, in the sense of those kind of entities, the utilities, the cable companies, the kind of companies with recurring predictable revenues that will really be pretty well insulated from this. Their stocks are selling off because investors are needing to raise money, and they're using those as sources of cash. But those are the kind of things that a month from now, 2 months from now, 3 months from now will actually come out of this quite nicely. So I think we're trying to evaluate both those things, look at where are our solvency risks in the portfolio and in the world, and where are our liquidity risks, and trying to sort of minimize the solvency risks and take advantage of the liquidity risks. I think just a couple other quick points from a macro perspective would be, number one, unfortunately, I just saw some headlines out of Governor Cuomo here in New York saying that the virus may not peak in New York for 6 weeks. We think the market will bottom well before you have a worst-case scenario in the virus. So the markets are always sort of a discounting machine looking forward, and we think the markets have put in a floor long before that. And lastly, we think that it's good that the world is finally taking very strong measures to mitigate the health risks. Obviously, like everybody else, I think in hindsight, we just wish governments had done more sooner. And that's kind of where we're at today.
Absolutely. Mike, with all that being said, clearly we're in uncharted territory. When you take a look at performance for the portfolio and how it's behaving, is it behaving as you would expect during this extreme volatility that we're seeing in the markets, or kind of like you're saying, as everything is getting hit within the market, is it holding up less well than you would have hoped for?
Yeah. So one of the hallmarks of the dividend strategy portfolio is that it's generally defensive in down markets. And that defensiveness has come because we have a quality bias in the portfolio. We're in companies that are generally well capitalized, and we focus on less cyclical companies that have a higher proportion of recurring predictable revenues. In addition, because of our emphasis on dividend payers, we find that the dividend component of the stock often provides downside support in a down market. In other words, market's selling off and people say, I'm gonna either hold on to this or I'm gonna actually buy this kind of security because even though I'm not sure what's going on with the price appreciation or depreciation in the stocks, I can get a great dividend from the security. So far, in this very swift sell-off, we have not proved as defensive as we have in past markets. And I think there's a few reasons for that. I think the first off is, as I mentioned sort of earlier, this idea of a solvency crisis and liquidity crisis. As people are searching for liquidity, they're selling everything. It started with things that are more closely tied to what's going on with coronavirus, air travel, hotels, et cetera. Then those go down so much, and people look at their portfolios and say, if I need to raise money, do I want to sell the thing that's already down 50%? Or take a little off the stock that's hung in there better. And so ultimately it catches up with the better names. And we've seen that sort of broadly, not just across the stock market, but across capital markets in general. So correlations have kind of gone to one, as the statisticians would say, and that in a market like this, where frequently you would expect that if stocks are selling off, bonds are rallying, a lot of those kind of things have unwound. So that in the last week or two, we've generally seen actually everything go down. Stocks went down, bonds went down, commodities went down, gold went down. It's a very tough market to differentiate performance. In addition, so there's that dynamic. One of the other dynamics we've seen is that within the equity markets, one of the sectors or areas that's held up the best would be the quote-unquote FANG stocks. And there's some good reasons for that. Those companies have very strong balance sheets. They tend to still be longer-term growth companies. And those companies don't pay dividends, so they're not the kind of companies we own in this portfolio. And so I think those two dynamics are at play. This idea that in the first instance, as people are just searching for liquidity, everything's selling off, and that within the stock market, some of these non-dividend paying areas have done better. And lastly, it's just been a challenging time for the equity income category overall. So I think within the category, we've actually done reasonably okay, but it's a challenge as we're seeing more broadly.
Absolutely.
We would expect or hope that over the next few weeks, as the markets sort of equilibrate, that you'll see some more stock differentiation as people realize that the first swipe was so broad-based and took down everything, and that actually that's provided opportunities. And I think people will flock back to the kind of high-quality dividend payers that we own.
Yeah, I completely agree. And maybe we could just switch directions a little bit here, and in terms of when we talk about the dividend strategy, regarding the dividend story itself, and in your conversations with corporate management teams that are managing these particular companies, do you have any concerns right now with companies in the portfolio that could potentially cut their dividends or outright stop paying the dividend altogether?
Yeah, I think broadly speaking, we actually feel very good about the dividend outlook for our portfolio companies. Keep in mind that dividend strategy's emphasis is on high-quality companies that are able to maintain and grow their distributions and their dividends over time. And so part of that high quality is about the balance sheet, or these companies with strong balance sheets, that they have recurring predictable revenues, so even in a downturn, they should be more defensive. And then there's also a key component, which is payout ratios. So we focus on companies with payout ratios that give them enough cushion that they can sustain the payout in a downturn. I think because of that, as I started off, we feel very good about the outlook for dividend payers in our portfolio. It's not to say you couldn't have one or two dividend cuts. Of course, that could happen. To the extent that we see those, we would try to act ahead of those and get out of the way of those risks before they manifest. I think, though, when we think about in aggregate, part of the thing that gives us such confidence is we think back to the financial crisis. And in the financial crisis, when obviously the world, and capital markets were really, falling apart, we had two dividend cuts out of a portfolio of, 45, 50 stocks. That was in two financials, General Electric and J.P. Morgan. And then in aggregate that year, while the growth rate for our portfolio companies was radically diminished, on average in the financial crisis, which, until now is the worst crisis we've had since the Depression in the capital markets, in aggregate, our portfolio dividends were up that year. They were up much lower than normal. So if you think in a normal year, your dividends are up 7, 8, 9%. After the financial crisis, I think we were up about 1.5 or 2. But we think that that's probably a reasonable analog for what to expect going forward here. The vast majority of our companies will maintain or grow their dividends. There could be, a couple, one or two or three dividend cuts. We're not forecasting those at this point, but depending on how all this plays out, that could happen. But in aggregate, we actually expect the dividends to be a source of stability and actually even growth in our clients' portfolios.
That's interesting because my follow-up point to that was I was going to ask you how have dividends held up in past market crashes, and clearly, as you allude to, 2008 being one of the greatest stress tests we've seen in the marketplace, dividends held up very, very well, particularly in the dividend strategy. So, in light of all this volatility, Mike, can you give us a sense of the risk management activity within the portfolio today, and give the listeners a sense, telling us where you're really finding opportunities in the market today as an active dividend manager.
Yeah. So I think if you think about the risks in the market and in the portfolios, they'd be in a few areas, right? So things that have changed pretty dramatically would be things like interest rates, oil prices, and then sort of, the outlook for, consumer spending, not on things like their cable bill, but on things like going out to dinner or the movies or et cetera. We think about our portfolio and those kind of risks, we're trying to, while looking at every company, I think those are the big areas we're focused on. So we're thinking about interest rate risk, in a lower interest rate environment, what does that mean for our financial companies? And we're thinking about how to address that and contemplating or executing on, repositioning the portfolio for less interest rate sensitivity, given that we believe that interest rates are likely to be at this super low level for at least the intermediate future. On the oil price, which has been another key dynamic of this, we actually have very little exposure directly to commodity prices. We have a reasonable exposure in the energy sector, but it's almost all in energy infrastructure, which, while the stocks have to date actually been quite volatile, we believe the fundamentals there are actually quite secure and the dividends are very secure. And then you think about the areas of like consumer spending and, the kind of places that are going to get hurt, from stores shutting down and restaurants and sales that just don't happen. We have relatively little exposure there. So at a highest level, those are the areas we're thinking about and contemplating. Then you drop down, and at the stock level, I think what we're trying to do is take advantage of this sell-off where there's dislocations. So, companies we've always wanted to own but couldn't make sense of the valuation, and, because somebody is forced to liquidate that holding on a particular day, we're able to, to move quickly and add to it. We're also sort of, I think, narrowing down the portfolio a little bit, exiting any names that were lower conviction and solidifying our positions in our highest conviction names. I think it's important to note, though, that while we're doing all this, we're not bottom fishing. And what I mean by that is, there are certainly some speculative type stocks that you could buy here, and if you're right, you could have big super outsized returns, maybe even orders of magnitude of what you paid for it. But that's not what we're doing. The real opportunity we see here today is to, while maintaining our quality bias and without going down on the quality ladder, finding companies with recurring predictable revenues, low economic sensitivity that shouldn't be down a whole lot in this market, but actually are. So that's where we're really focused.
Okay, interesting. And I'll give you one last question. And clearly, you and I are both doing this call remotely. Our office is closed, so we're forced to work remotely from our homes. And with that as a backdrop, what signs are you looking for as you look at the economy, you look at this volatility that's taking place? What signs should we be on the lookout for in terms of seeing a potential recovery actually taking place today?
Yeah, so I think I go back to what I said at the beginning in a few different points, which is, number one, I think first and foremost, as bad as the panic feels right now, in the markets, in a perverse or reverse way, that's almost a good sign for the recovery, in the sense that, like I said earlier, I believe the markets will put in a bottom long before the peak in the virus out in the community and for public health. And the intensity of the sell-off to date and the panic to date has been so high that I think we're actually probably closer to putting in a bottom than a lot of us may actually feel. I think financially the kind of things you're going to look for, I think we've already seen one, and I think we're close to seeing the second of the two biggest things that I'm looking for, or we're looking for, to sort of put in a bottom. The first is obviously the central banks around the world have stepped up and provided a tremendous amount of liquidity, and this should address the funding issues in the capital markets and with banks to ensure that there's not a liquidity crisis that causes sort of financial contagion in that regard. And then the second thing is going to be a fiscal response, and I think the U.S. government, I think, was relatively slow to address a lot of these things, but has I think as maybe as the U.S. is fashion a lot of times, but once the government addresses it, they really go after it in a big way. And so I think you're seeing comments about fiscal stimulus packages that could be close to $1 trillion, which would be a very meaningful boost to spending and a very meaningful number as a percentage of GDP. And I think that the combination of that sort of radical monetary policy, or I don't know if I should say radical, but really strong, aggressive monetary policy, then followed with a very strong, aggressive fiscal policy, should put a floor in, or provide the basis for a floor in the capital markets. And then from there, I think what's important to note is that, again, and listen, hopefully, the experts are right, that if this all peaks in 6 to 8 weeks, while there will certainly be long-lasting implications from it, we may look back in what feels like a long time as we're all cooped up in our houses and can't do anything, but in 3 or 4 months, and listen, this isn't just going to be a small road bump. I mean, it's a big deal, and unfortunately, there's going to be a lot of real loss in terms of health and suffering and those sorts of things. But from an economic perspective, we may look back 3 or 4 months from now and realize that this was actually, after the Fed stepped in, after the government put in a massive fiscal policy, given the low rate environment we're in, that this was proved to be a pretty good opportunity to actually be putting money to work. So I think that's what we're looking for.
Okay, terrific. Well, Mike, thanks so much for joining me today. It really is greatly appreciated during this challenging period that we're going through. And listeners, thank you for joining us today. Please do not hesitate to reach out to us with questions, or and also contact your local regional Legg Mason representatives wherever they may be helpful to you. But one disclaimer I need to note before we get off this call, please note the following. Past performance is no guarantee of future results. The opinions and views expressed in today's call are of the individual speakers as of March 17th, 2020, and may differ from other managers or the firm as a whole, and are not intended to be a forecast of future events, a guarantee of future results, or investment advice. Any statistics referenced have been obtained from sources believed to be reliable, but the accuracy and completeness of this information cannot be guaranteed. Neither ClearBridge Investments nor its information providers are responsible for any damages or losses arising from any use of this information. Thank you.
Thanks to all our participants for joining us today. We hope you found this webcast presentation informative. This concludes our webcast. You may now disconnect. Have a great day.